All right, I found three excellent US dividend ETFs with yields from 2.9% to 3.9% that could start paying you quarterly income immediately and are perfect for anyone within 10 years of retirement. First up, we have SCHD, the Dividend Quality Champion. SCHD is the Schwab US Dividend Equity ETF. Think of it as the gold standard for dividend investing. It's like having a team of analysts screening for the highest quality dividend companies in America. SCHD charges just 0.06% per year and owns 103 companies that have paid dividends for the last 10 years consecutively. These aren't just any dividend stocks, they're selected based on fundamental strength, including cash flow to debt ratios, return on equity, and dividend growth rates. SCHD currently pays about 3.9% annually, distributed quarterly. What makes SCHD special is its focus on dividend sustainability and growth. It tracks the Dow Jones US Dividend 100 Index, which doesn't just look for high yields, but actually screens for companies that can maintain and grow their dividends over time. The top holdings include quality names like Cisco Systems, Bristol Myers Squibb, BlackRock, and Home Depot. If you were to invest $70,000 here, you generate around $2,730 per year or $683 quarterly. And really quick, I've noticed over 80% of people watching haven't subscribed. An easy way to help this channel grow for free is hitting the subscribe button, and I promise to keep making helpful videos like this. Your second option is VYM, the Diversified Income Powerhouse. VYM is the Vanguard High Dividend Yield ETF. And if you want broad exposure to dividend paying stocks with Vanguard's legendary low cost, this is your pick. VYM holds about 538 companies and pays quarterly at 2.9%. It costs an incredibly low 0.06% annually, matching SCHD for rock bottom fees. What's unique about VYM is its breadth and its market cap weighing approach. It tracks the FTSE High Dividend Yield Index, which includes the higher yielding half of dividend paying large and mid cap US stocks, including REITs. This gives you exposure to dividend aristocrats and high yield companies across multiple sectors. The top holdings include Broadcom, JP Morgan Chase, ExxonMobil, and Home Depot. The lower yields means less immediate income, but you get much broader diversification with over 500 holdings compared to SCHD's 102. If you were to generate $70,000 here, you generate around $2,030 per year or $508 quarterly. This is perfect if you want maximum diversification across the US dividend universe. Your third option is DVY, the Value-Focused Income Specialist. DVY is the iShares Select Dividend ETF, and it takes a more concentrated approach to dividend investing with a focus on value characteristics. DVY owns about 109 companies and pays quarterly at 3.8%. It costs 0.38% annually, higher than the others, but it's still reasonable for what you get. What makes DVY different is its concentrated portfolio and sector tilts. It tracks the Dow Jones US Select Dividend Index, which focuses on companies that have consistently paid dividends and screens for dividend sustainability. The fund tends to be heavily weighted towards utilities, financials, and energy companies, giving it more of a value tilt compared to the others. So if you were to invest $70,000 here, you generate around $2,660 per year or $665 quarterly. This option offers higher current income than VYM, but with more concentration risk. So which one should you choose? Well, these three US funds have meaningful differences in their approaches and holdings. SCHD focuses on dividend quality and growth with 103 carefully selected companies. VYM casts the widest net with over 500 holdings for maximum diversification, and DVY takes a more concentrated value approach with about 109 companies tilted towards traditional dividend sectors. So the overlap does exist, but it's much less than you'd see with Canadian funds. You're getting three genuinely different strategies for accessing US dividend income. So here are your three strategies. Strategy one, pick your favorite. Choose one that fits your investment philosophy. SCHD, if you want the highest quality dividend growers with strong fundamentals. VYM, if you prioritize broad diversification and ultra low costs. And DVY, if you prefer higher current income with a value tilt. Strategy 2, split between the two. Maybe 60% in SCHD for quality, 40% in VYM for diversification, or 70% in VYM for broad exposure, and 30% in SCHD for dividend growth focus. Strategy 3 is equal weight in all three. About 33% if you want exposure to all three approaches: dividend quality, broad diversification, and value-focused income. Honestly, unlike Canadian dividend ETFs, these three approaches are different enough that combining them actually makes sense from a diversification standpoint. This strategy is perfect if you're looking for US market dividend exposure and want quarterly income payments. It's great for anyone who wants exposure to American dividend aristocrats and quality companies, especially with favorable tax treatment of qualified dividends for US taxpayers. But remember, US dividend ETFs typically have lower yields than their Canadian counterparts because the US market includes more growth-oriented companies. You're trading some current income for exposure to the world's largest and most dynamic economy. And if you can't handle seeing your account value swing up and down, these dividend ETFs will be more stable than growth stocks, but they still move with the broader market. Now, here's how to actually implement this. First, start smaller than you'd think. Don't put $70,000 on day one. Start with $5,000, get comfortable with the quarterly payments and price movements, then gradually build up. Second, set up automatic dividend reinvestment with your US broker. Most brokers like Charles Schwab, Fidelity, and Vanguard offer this for free, and it automatically buys more shares with your quarterly payments. Third, if you choose multiple ETFs, rebalance once per year. If one has grown much larger than your target allocation, trim it back and add to the others. This forces you to sell high, buy low automatically. And if you want to calculate your exact returns with your investment amount, check out the free investment profit calculator in the description or first pinned comment. The bottom line is the US dividend ETFs can generate solid quarterly income while providing exposure to America's highest quality dividend paying companies. But remember, you're trading some yield for exposure to the world's most innovative economy, and you need to understand exactly what you're buying. Whether you choose one ETF or a mix and match approach, this works incredibly well for investors who want exposure to the US dividend growth companies and potential for both income and capital appreciation over time. The key is picking the approach that matches your preferences and sticking with it consistently over time. Now watch these two videos for more investing tips.